And your money this week. Stocks have had a good week. The S&P 500 is up about 1.2% since last Friday. Small caps are up roughly 2.4%. Emerging markets have jumped about 4.1 and developed international markets are ahead about 0.7%. Bond yields have actually come down a bit. The 10-year is off by about 11 basis points, sitting near 4.44%, which may reflect a little less concern about the economic fallout from the Iran conflict, or it may not, as these talks are confusing the heck out of me. I don't know, Andrew, if you're the same, probably are. On the economic data front, the PCE, or Personal Consumption Expenditures Price Index, or an inflation reading, came in high at 3.8%, but in line with expectations. And the latest Case-Shiller home price report shows that home prices aren't rising very much and are definitely not keeping pace with inflation. Andrew and I are going to get into all this and more. Apparently, some biblical rain in the Atlanta area. But Andrew, what's up?
Not much, man. Yeah, I mean, you really buried the lead there. I think the story of the week is how much rain there's been in the southeast. It's tropical.
Yeah.
It's been really bad. It's so bad that the other day I was walking around outside and my wife and kids were like, "Why are you walking around in the rain?" But it was barely raining, so it felt like it wasn't raining. I mean, it's tough.
Yeah, I mean, this is all your way of creating a very elaborate ruse and excuse because we have a pretty aggressive step challenge going
Yeah.
on in within Garmin, within the industry, and you were doing great last week, and this week it's like you're doing okay relative to the rest of mankind, but you've really fallen off, and you've just started sending us these random weather reports as if it would explain anything.
I mean, the other another incident. I mean, this is really causing issues on the home front. I had to explain to my wife the other day that while I was cooking, had something going on the stove that I'm keeping an eye on it. Number one, but two, like I'm not nervous or stressed, but I got to get some steps in. So it's just like pacing around the house.
Yeah.
It's not good.
Well, the amazing thing is there's nothing on the line in this challenge, and
You
people
know?
are just walking their or drive whatever they're doing, they're nonstop moving. But
Well, you keep adding world class, endurance athletes to the group, and it's getting harder and harder. I
I
don't
know
like that.
we're gonna have two
I like
divisions.
them, but I don't like them in the competition.
We're gonna have two divisions: the lazy guy division and the runners division. And I know
Yeah.
which division you and I will be crushing in.
Yeah.
So, thoughts on the PCE reading?
I don't have a ton to add, other than kind of what you laid out. I mean, I think the elevated level was expected. It was in line. When you look into it, I continue to think that regardless of your inflation measure, we're probably at the peak or certainly close to the peak, uh, given just what's actually impacting things. When you see a massive increase on gasoline and other energy goods, a pretty, sizable increase on things that are impacted by that, food and beverage, things like that moving up. Um, I don't have a prolonged concern. I still don't have that, but I continue to think we're at an elevated level. I mean, you mentioned the conflict with Iran. Whether we're right or wrong, it's certainly our house view that it seems like we are getting closer to a deal. And Ben, who's our chief investment officer, and he's on our morning call, the morning market briefing that we always reference. He noted today part of the anecdotal support of that is just the fact that the deal points are coming from multiple people and they seem to be pretty consistent, which seems like hey, there's probably some fire here. There's a lot of smoke that actually makes sense. So, if that is the case, then I continue to think whatever the top level is, and I think we're close to it, we're going to see it on the inflation reads for probably a period of about 2 months. And part of that is just the timing of it. That might seem odd. You'd say, hey, well, the war, if it were to end this weekend, wouldn't we see this come down? It's like, well, we're looking at April data on PCE. And guess what, guys? May's almost done. And so,
Yep.
we're going to stay at those levels for some period, and they're not going to immediately wash out in June. Gasoline prices have come down, but they're down around 5.5% over the last 10 days. They're not back to where they were.
Yeah.
And so it's going to take some time for that stuff to filter through.
I don't disagree. I do hope you guys are right. I think it's a very reasonable assessment based on what we're all reading and seeing. So then on Monday, the Wall Street Journal ran a front page piece on the equity risk premium, and they were using it basically to make the case that stocks are very expensive. You guys talked about it again on the Morning Market Briefing podcast. Check them out at Narwhal and wherever you get your podcasts. And also, please like this video, subscribe to the channel so we can keep going. Um, so, equity's expensive. According to the journal, you guys talked about it on your podcast Monday. I wanted to share a little bit of background data that may help frame the question. It's just an update on the chart I shared with you last week. But if you look at how stocks are doing since 2022, since the market low, the S&P now has more than doubled. It's at an all-time high. The Russell 2000 small caps all-time high, up 75%. Developed International, MSCI EFI up 87%, just under 1% from its all-time high. And emerging markets, again, at another all-time high, at having doubled basically since then. So what happens, and we talked about it, is stocks are doing really well. Yields went up, bonds sold off. So bonds, not doing so well. All of a sudden, this equity risk premium, which I want you to explain, you can use it to make a case that stocks are too expensive.
Yeah. So when you think about the equity risk premium, the way to think about it is as if you have an array of assets that you could invest in. And so the equity risk premium is essentially what is my expected return for this investment, whether it's an individual stock or it's a sector, or more commonly speaking, a broader representation of the market. So picture an index. Minus the risk-free rate. And typically, when people think about the risk-free rate, they think about the US 10-year Treasury. That's just kind of the textbook default way of thinking about it. And so if you said, hey, I think that stocks are going to be up 8%, but the 10-year has moved and it's moved from, insert low number here to higher number where we are now, call it 4.5, you would say, well, if I still think stocks are going to return 8%, I'm not getting much more juice than the risk-free rate. If the risk-free rate is 1 and you think stocks are going to give you 8, okay, I'm getting a 7% premium for owning the market if my expected return is consistent with what is anticipated. But if you say, well, you can get 4.5%, say, on a 10-year, all of a sudden that 8% number is dropping, only adding 3.5%. So you're getting less of a premium for owning the stocks, which traditionally speaking would be something you'd say, okay, well, is that worth the risk? Is it worth holding that? Stocks now seem less attractive because of that. Now, the challenge with that is not so much on calculating and understanding the risk-free rate. It is twofold. One is, what is the actual expected return of stocks? And that really comes down much more so, I would argue, to valuation and actual earnings performance than it does historicals. We talked last week, or maybe 2 weeks ago, we had the quiz on different market data points and how often was the market up and how often was it close to all-time highs, things like that. Those data points are nuanced, but actually more appropriate than just saying, oh, I think stocks are going to be up 8. So the challenge is, what is the actual expected return on stocks? And the other piece is, how long will the risk-free rate remain where it is?
Right. Because it could go, it's moved around a fair amount.
It could go either way.
Right. Yeah, I mean, here's how I think about it, and I appreciate that explanation for our listeners. Measures like the equity risk premium or the CAPE, cyclically adjusted PE, or just PEs in general, forward, trailing, they tell you something, but they are historically terrible market timing
Mhm.
tools.
Yes.
When they indicate stocks are expensive, it has not meant it's a good time to get out. Very often they stay expensive, or as you mentioned, things adjust and stocks keep doing well. So you can't use these as timing tools, which is why I was surprised that this was kind of a page worthy article from the journal. I mean, we said last week stocks have done really well, bonds have sold off, and if yields stay roughly where they are, they look pretty cheap now.
Yep.
So maybe the journal, they're one of our 43 subscribers, and they decide to
They're,
turn
they're,
it into
they're picking up on it.
some newsworthy stuff. But um, I've never known. So what do you do with it, right? So I've never known a serious investment approach that says, because one of these valuation metrics has moved, it's time to really change up our allocation, or all of a sudden let's suddenly load up on bonds because the equity risk premium is suggesting fixed income. I mean, I remember the firm that I worked at in the 2000s. They had a tremendously interesting asset allocation approach, and they were stock pickers basically. And when their analysts, and they were very price conscious stock pickers, and when their analysts like stocks, the equity exposure in the portfolio would increase within reason, like within a risk return parameter. And when they didn't, they would decrease. And I remember asking the head of fixed income, was there anything you would ever see in the fixed income markets that would cause the firm to use bonds as the lever of, buy
Mhm.
more, they're extremely attractive? He goes, it's a good question, but it's just never happened.
Yeah.
I mean, you can adjust fixed income exposure on the margins, but I don't think you look at these ratings and all of a sudden you say, oh, my 65-35 portfolio should really be 55-45 because bonds are so attractive.
No, actually, I think you're spot on that. For us internally, the number one driver of what might be outwardly perceived as a reallocation or a restructuring of the portfolio is actually just when you have a sell off in bonds and a run up in equities, it's essentially just forced discipline. We're not saying that, hey, we like bonds necessarily more than we like stocks, even though we may be selling stocks to buy bonds. What we're saying is we're supposed to be 65-35, and now we're closer to 70-30 because this asset class has decreased and this has gone up. We're not necessarily making a call. It's more that, hey, we want to return to that discipline. But if you just looked at the trading activity and you didn't know historical and you didn't know asset allocation targets, you might say, hey, Narwhal's really making a call. And objectively, I do think it's a good time, as we've said repeatedly on this call, it's a good time to be, picking up some of that fixed income. But I don't necessarily view that as we're not making equity decisions because bonds are attractive.
Yeah, and I think what you're saying is how we would approach it as well. What it does mean is that you can rebalance. You can be
Right.
disciplined, right? Like if your stocks have been running and fixed income has not been doing as well, you may want to look at your portfolio and get back to your original target, your original risk return target. You may want to be disciplined about it. Historically, I've seen firms use fairly wide rebalancing bands, meaning, if you were at 65 and you get to 66, you don't automatically go back to 65. There's tax implications, but also you want to let your winners run, and small deviations aren't going to meaningfully change your long-term risk return profile. But given the run that we've had in equities and the improvement in bond yields, it is perfectly reasonable to look at your portfolio and consider whether you want to do a manual, proactive rebalance to get
Yep.
things back to target. And so that's where I think conversations about the equity risk premium and other valuation metrics can be useful. You can't make massive shifts, but you can rebalance, you can get back to target, you can be disciplined, particularly if you know, I guess want to take some chips off the table because you feel like
Mhm.
it's been a really good run. All right. So that's what we think about the equity risk premium. So read about it, but don't do much.
Yeah, I'm with you. It was very fascinating to me that was front page news.
Yeah. Must have been a slow day. I don't know.
I mean,
We'll
because
see.
I view that as an interesting topic from an educational standpoint, and I think it's
Yeah.
something that a lot of people haven't thought of. Do I view it as news? Not really.
Well, let's see if the front page on Monday is all about how to rebalance your portfolio. Then I'll know we've really,
You
we're
should think
really a
about it.
feeder system for the big institutions. All right. So, home prices. I shared an article on my Wednesday reading list that I think is worth talking about. It pointed out that over the past year, this is based on Case Shiller and then another study, home prices have increased by about 0.7%, according to Case Shiller, and 1.7%, according to another study. Both of these readings are below inflation over that period, right? Which means homeowners have actually had a negative real return on their homes. It's not uniform. Nationally, there are winners and losers. The Northeast and the Midwest are still fairly strong, I think, because of tight inventory. Parts of the Sun Belt and the West have been harder hit. But price appreciation is slowing down across the board versus a year earlier. We've shared some concerns about residential real estate and how it could impact the economy, but what's your read on this sluggish, nominal home price growth? And I'd love to hear your thoughts as to whether this is why you're skeptical of the inflation readings that we've been getting that shows shelter costs have increased so much.
Yeah, I to contrast this, because I think I was just, the angry man yelling at the sky as it rained on one of these calls. When I derived the CPI formula and the weighting placed on housing, this is exactly what I'm talking about. Because in our most recent CPI reading, we had an annualized shelter increase of 3.3%. Um, the way it's calculated, we've talked about ad nauseum, but when we get to more underlying, I would argue more accurate data, the number is significantly lower than that. And shelter is a massive portion of the CPI calculation. And I think the number is incredibly inflated. I'm not surprised. If anything, I might actually be, if the 0.7% annual gain is correct, I'm actually pleasantly surprised by that number. I would not think it was that high. I look at the mismatch between buyers and sellers and nationwide as well as here locally, and there's just so many more people looking to sell a home than looking to buy. We are seeing strong reporting data that suggests that realtors are getting out of the business. They're
I
finding
did see
something
that.
else to
Yep.
do. Those are not things that you see in an environment in which houses are selling and they're selling for more, even selling for zero point 0.7 more, but certainly not if they're selling for 3.3 more. So I think that gap between what's being reported in the inflation data, I think inflation's continuing to be propped up in CPI by the housing component, and I just don't think it's accurate.
Yeah, I mean, it's hard. Sometimes things seem too simplistic, but when you see home prices move at one rate and the shelter costs within CPI readings move at a completely different rate, it's a fair point, and that's what people want us to do, right? Get beyond the headlines and dig next level and make decisions for them based on that. So I want to maybe get us out on this. Maybe to plant the seed for the next couple weeks. I've read headlines about, there's some troubling things I would say in the economy. 401k loans are up, saving rates are down, people are buying fewer cars. A lot of that's anecdotal. You're not going to do anything with it. But what's the next reading or set of readings on the economy that you and your team are going to be looking at, maybe to assess whether the consumer is in tough shape in the US?
Yeah, I mean, there was a big report today from the Wall Street Journal on credit card delinquencies. I mean, that's data that we watch very closely. I would suggest that if you do, I would suggest that you read that article. Also recognize the data set that is being sampled there. So that's something we're actively digging in a little bit more on.
Okay.
The credit card companies, by and large, say, "Hey, delinquencies are falling kind of, but they're in the 1 to 2% range holistically across all cardholders." The Wall Street Journal report is highlighting those who carry a balance consistently. And they're seeing long dated delinquencies. So folks that are 90 days plus delinquent, they're seeing of those that carry a balance, that number's ticked up to 15%, which is a big number. Now, obviously, embedded in that is there's an awful lot of people that aren't carrying a balance, and that's how we get to the 1 to 2% number.
Yep.
And there's a lot of people that are carrying a balance and are still making their payments, but that's something that we would be looking at closely. We like looking at Costco sales data. I think that's often a really good read through on what people are actually spending money on. We've gotten a real interesting picture from earnings from retailers, just everyday retailers, where you had companies like Best Buy that were just off to the races yesterday. And then you've had other retailers that have really, really struggled. I mean, Kohl's did really well, Gap's down 17%. So we're getting a really uh, messy picture of kind of these everyday retail. What are people doing? But we're looking at the credit card data. We're looking closely at that right now. I may have more to share with you next week. I'm not looking at it, but somebody is. And for us, I mean, as we look ahead into next week, I mean, we continue to. I think the biggest report next week, everyone will talk about the jobs data. You know where I stand on the jobs reports.
Yep.
But I think the ISM manufacturing is going to be interesting on Monday just to see what kind of activity we're seeing. I mean, positively, we're seeing lots of business formation. We're seeing economic data that's really generally speaking, would be positive. But the credit card thing is often a good read through on where we are. And so we want to kind of get a better narrative on that.
As a reminder, where do you stand on the jobs data?
I don't like it. I think it's like wildly inaccurate. I don't think it's low. I don't think it's, I don't know. I just think it's so inaccurate. I mean,
Yeah.
it's crazy to me that we can't come up with a good jobs number.
Yeah, and while we're on important topics, what do you didn't comment on my golf shirt today? I didn't know if you could
I can't.
notice
Oh,
anything.
Bama.
Yeah,
Oh,
it says
that's
Big Brother.
disgusting.
Yeah, nothing.
That's disgusting.
So I think our viewers who don't already know you aren't aware that you are a college football expert.
My bad.
Yeah. So where are you on expanding the playoffs, and how anxious are you for the next season to start?
I'm very ready for the season to start. I'll tell you that. That's always the case. I've been ready since February. So I'm very ready for the season to start. I have maybe of the more invested you are in college football, I think the more inclined generally you are to not want playoff expansion. And I think I'm an outlier on that chart. I'm fine with more playoff games. Um, I think they're fun. Like I love an excuse to turn on the TV and on a Friday night in late December and watch a playoff game. I think it's a lot of fun. I am in favor of more college football games.
All
Period.
right. So you're the
Uh,
first guy who's super into it who
no,
wants the
no
expansion.
one agrees with that take, but
Okay.
that like I am in favor of more college football games between teams that are ranked, and an expanded playoff gives you that.
All right. More chances to see UGA 7 or whatever number you guys are on, like trotting
Oh
with,
man,
with his
we're
little legs
flying
around
through
the
them right
court.
now.
All
We're
right.
flying through them right now.
All right, buddy. Have a great weekend. Thank you. We
All
will
right, man.
chat
Have a
next
good
week.
one.
All right.